Alright guys, it's time to add another video to my free stock market education playlist called Stock Market for Beginners in 2019. And you can find the playlist up here down in the description or at the end of this video on a clickable card. But in today's video, we're going to talk about how to value stocks very quickly without having to do a bunch of different calculations or make some very difficult predictions. Now, obviously, you always have to do a ton of research when valuing a company and deciding to invest in a stock, but if you're a beginner and you're just kind of looking for a good place to start, then I think this video will be perfect for you. I'm also going to leave you guys links to all the different websites that we use today down in the description. All I ask in return is that you please hit the like button if you enjoy the video and you want to see more educational videos in the future. But with all that said, let's go ahead and get started. What's up everybody, my name is Ale and welcome to my world of stocks. Alright, first things first, I hope that you all know by now that the price or the share price of a stock has really nothing to do with the actual value of a stock. In fact, a $10 stock can still be incredibly overvalued, while a $100 stock can still be incredibly undervalued. And it's really only when we factor in a company's sales, earnings, assets, or debt levels that we start to realize whether a stock is really cheap or expensive in relation to other stocks in the market. Which, by the way, I'll even show you guys later in the video how to look at multiple companies within the same industry, and so you can kind of compare the different stock prices and valuations. But with that said, let's go ahead and start by taking a look at one of my biggest stocks, which is AT&T, ticker symbol T, and we're going to start with a website called Yahoo Finance that gives us a very quick and kind of basic overview of the stock's valuation. Okay, so here's the website, finance.yahoo.com, and in the search bar we type the letter T as the ticker symbol for the stock and then click on the statistics tab, where we are greeted with a few basic valuation metrics and ratios. And we'll just quickly run through the primary ones that I tend to look at, and I'll give you a quick description of each so that we're all on the same page. Now, the first one you see here is the market cap, and that's just the total dollar value of the company in the stock market, and it's calculated by multiplying all of the company's outstanding shares by the price of each of those individual shares. And this can be helpful because a stock's share price alone does not tell you how big a company is or what their total value is. So the market cap can help fill in some of the blanks for that. And generally, I categorize market caps into large caps, medium caps, and small caps. I think of large cap companies as anything above $10 billion, medium cap as anything between $2 and $10 billion, and small cap as anything under $2 billion. There's also mega cap companies, and I would classify those as anything above $200 billion. In general, smaller cap stocks tend to be a lot riskier as they're usually less proven companies, but they may also offer more upside potential. Pretty much all of my core positions, however, are either large or mega cap stocks, as they offer a lot of stability to my portfolio. And in the case of AT&T, I personally would consider it a mega cap stock, as its market cap is well above $200 billion, as you can see here. Okay, next up here we have the enterprise value, and this is basically the market cap plus all of the company's debt minus their cash. So it's usually used as a more comprehensive approach to determining how much a company is really worth, especially if someone wants to try to purchase the entire company, because obviously you would have to be taking on their debt as well if you make that purchase. And while it's not typically used by small investors like you and me all that often, it can still be useful just to get a quick idea of how much of a burden their debt can be. In any case, AT&T is well known for having some pretty massive debt levels right now, which we'll look at later in the video when we talk about balance sheets, but their enterprise value is much higher than their market cap as a result, and that's obviously an alarming sight. For reference, a company like Google, who by the way has one of the best balance sheets in the world, if you don't believe me, you got to take a look at it. It's absolutely massive how much cash they have especially, but they have an enterprise value that is much smaller than their market cap. All right, here's where things start to get interesting. It's time to take a look at the PE ratios. Now, a PE ratio, or a price to earnings ratio, is calculated by taking the price per share and dividing that by the company's earnings per share, or what we refer to as EPS. And this gives us a general idea of how expensive the stock is in relation to their profits. And the lower that this number is compared to its competitors, the cheaper or perhaps more undervalued the stock is considered, because you're essentially paying a lower price for the company's earnings or performance versus their competition. And I'll show you how to look at the competition in just a second, but also keep in mind that a higher PE ratio can sometimes be the result of investors willing to pay more money for the company now because it is expected to have higher growth in the future. So the general rule of thumb is that high PE ratios are usually attached to growth stocks, while low PE ratios are usually attached to value stocks. Of course, there can be some great exceptions to this, and we could even argue about what technically makes up a value stock, but again, this is just in the general kind of basic or broad sense. Also keep in mind that a stock might have a high PE ratio based on hype that isn't really justified, while a low PE ratio can also be caused by something being fundamentally wrong with the company or their future outlook. So make sure you do plenty of research rather than just jumping into a stock blindly based on only a few metrics. In any case, the PE ratio is usually broken down further into what we call the trailing PE ratio and the forward PE ratio. Now, when looking at the trailing PE ratio, that just calculates the ratio using the company's earnings from the past 12 months or the last 4 quarters. So it basically tells you how expensive the stock is in relation to how they've performed so far in the past year. Now, the forward PE ratio does the same calculation, except that it uses the earnings expectations for the next year or upcoming 4 quarters based on analyst estimates. And so you can see why some investors would prefer to use the trailing PE ratio, because it's based on actual performance that has already happened, while other investors might prefer the forward PE ratio because it gives them a better idea of where the company is expected to be in the very near future. But honestly, both metrics are extremely valuable, so I recommend that you always look at both. Now, in the case of AT&T, they have a pretty good trailing and forward PE ratio of just 11.78 and 8.59 respectively. But how do I know that these PE ratios are good? Well, this is where we can start making some comparisons. For example, you can go to multiple.com, which I'll have it linked down in the description, just like all the other websites. And here you can see that the PE ratio for the S&P 500 currently sits much higher at over 21. More importantly, we can look at the PE ratio for the industry that AT&T actually operates in, which in this case would be the communication services sector. And to find this, we can go to the industry page on gurufocus.com, and on the left-hand side, we can click on the industry that we want. So we'll click on communication services, and once we're here, we get a ton of useful information about their competitors and the overall industry itself. So we'll come back to the competitors in just a second, but it looks like the PE ratio for the industry is much higher than AT&T, coming in at over 27. Now, if we look at their major competitors, we still find that AT&T's PE ratio is much lower than both Verizon and T-Mobile, so in this case, you could use some of this information to build a pretty strong argument for AT&T being a relatively cheap stock at these prices in comparison to industries, the market in general, or their just kind of biggest competitors. But we'll continue on with our quick analysis for now. Now, moving on to the next metric, that's going to be the PEG, or the price to earnings to growth ratio. And in this case, AT&T is a little high at about 3.43. Now, the PEG ratio is useful because it factors in future growth, usually 1, 3, or even 5 years out based on analyst estimates. And you can calculate it by dividing the PE ratio by the EPS growth rate. And in general, a PEG ratio lower than 1 is generally considered an undervalued stock because it would mean that their expected growth is actually exceeding the PE ratio. So a PEG of exactly 1 would mean that the PE and the company's earnings growth rates are basically equal. Therefore, many investors would consider that to be a fair value for the stock. But anything above 1 might be getting a little expensive since you're paying a higher PE than the actual growth rate. I know it's a little confusing, but the best practice would be to just compare the PEG ratio of a stock to its major competitors to get a good idea of where it should be trading. Also, because the PEG is so heavily reliant on accurate analyst estimates, I would recommend that you always look at multiple multiple sources, and that also goes for any other metrics that we use in today's video as well. Now, you might be wondering, well, what do you do if a company is not profitable and therefore doesn't have positive earnings to calculate all of these different ratios? Well, that brings us to the PS ratio, or the price to sales ratio. And this is basically taking the same approach as the PE ratio, except you're using a company's sales or revenue to make your calculation. And with this one, a PS ratio of less than 1 means that you're paying a smaller price than their sales, which is generally considered a good thing. But just like the other metrics, you should really compare it with the rest of the industry or some similar companies going through similar situations. In any case, if the company you're looking at is profitable, then most investors will just stick with the PE ratio, but in AT&T's case, they have a PS ratio of about 1.28. And finally, we have the PB ratio, or the price to book ratio, which currently sits at 1.23 for AT&T. And this just replaces the denominator with the equity per share. In other words, we take the assets of a company, subtract their liabilities, and then divide that into the stock price. And this helps us understand whether or not we're getting a lot of the company's net assets in return for the price that we're paying. And just like before, a PB ratio of less than 1 is generally considered a great value. Okay, and before I end the video, I just want to mention 3 more aspects real quickly. One is that many investors like to see the price to free cash flow ratio, and you can also find that on Guru Focus. That's the website we used before, and in AT&T's case, it is much lower than the competition at just about 8.61. Number 2 is that many investors, including myself, put a ton of value into a company's balance sheet when we look at a stock or when we try to value a stock. So I'll link below a video for you that I made that explains everything about a company's balance sheet and where to find it and how to properly read it. But just in case you're wondering, Nasdaq.com is a great site for that. And as I mentioned before, AT&T's balance sheet is absolutely horrendous, as they only have $51 billion in current assets, but over $64 billion in current liabilities, and a massive $166 billion in long-term debt. So there's no way to sugarcoat it. It is one of the worst balance sheets out there. And obviously a big concern for AT&T. Luckily, they do have a lot of cash flow that kind of helps, but in any case, I'm not going to try to sugarcoat that. The balance sheet is really bad. Now, finally, number 3 is dividends, since that can sometimes influence investors when choosing a stock. And I'll also link to you one of my dividend growth videos that is very popular on the channel. But my favorite website for dividends is seekingalpha.com. And you can see here that AT&T pays a current yield of about 6.5%, which is very high. And by the way, I bought the stock when it was even cheaper than where it's at right now. So my yield is actually higher than 7%. So that's a very big dividend. But they also have a payout ratio of about 57%, a very small 5-year growth rate, but an absolutely massive 35 straight years of consecutively growing those dividends every single year, even through recessions or market crashes or what have you. Anyway, I think that just about does it for today's video. Now, obviously, these are all just very tiny pieces to the overall giant puzzle, so make sure you always do tons of research before even choosing a stock. And we didn't even go into a company's competitive advantages over the competition, or how strong is their brand, their products, their services. Those are all very important things that you have to research further. But anyway, I hope that you enjoyed the video. If you did, make sure you hit the like button, subscribe if you haven't already, and I'll catch you guys in the next video. Take care. Bye-bye.